Hello, Business Finance. This is Professor Hassey. It's week 2 of our finance course online. This week's topic, financial statements, chapters 3 and 4 on describing the key financial statements and what is financial statement analysis, measuring corporate performance. No graded work this week. I will post your grades and post my responses to your portfolio review in my Friday update video of this week. And next week, we will be studying Chapter 5, the time value of money, and our first assignment, which will be posted this coming weekend and due Sunday, June 26th, the first assignment of our opening 2 weeks of our course. So tonight is financial statements. And let me just go over a couple of key points in Blackboard for you to refer to in your review of this week's material. I update Blackboard about 2 or 3 times a week. So you just have to stay on top of this every week or every couple times a week just to make sure what's going on. Again, week 2 is our study this week. There's our learning assignments for this week. And also our lecture notes, which is a spreadsheet explaining real world application of financial statements. And I'll go over that in our video for today. The definition of what we're doing this week, our finance fact this week. Last week, it was the S&P 500, which is a part of your portfolio. This week, it's the Dow Jones Industrial Average. What is it? Our review of chapters 3 and 4 with PowerPoints and a video, which we're going to watch right now explaining financial statements.
We are going to discuss 3 common financial statements: the income statement, the balance sheet, and the cash flow statement. Are you familiar with these documents and why they matter to you? If you own your own business or even run a division of a business, it is imperative that you understand these statements because they tell you about the general financial health of the company. Also, if you have ever invested or considered investing in a company, whether through the purchase of stock or through a loan, you'll want to understand the company's financial health. In this program, we will explain each of these 3 statements and what their purpose is, how to read them, and how they can be applied in a real-world setting. So why is it important to understand all 3 financial statements? Basically, each one tells only part of the story. They are somewhat like pieces of a puzzle, and you need all 3 pieces to see the big picture. Let's begin by reviewing the general purpose of each financial statement and what distinguishes one statement from another. Simply put, the income statement tells you whether or not the company is profitable during a given period, usually monthly, quarterly, or annually. It may be helpful to think of an income statement in terms of a video camera. At the start of a period being measured, you hit the record button, and the camera starts recording everything that takes place until you press stop. Similarly, an income statement indicates how a company is performing over an extended period of time. Knowing whether your company was profitable over a period of time does not necessarily tell you how much money the company has right now. That's what the balance sheet is for. In contrast to the income statement that records transactions in time like a video camera, the balance sheet is like a still camera, showing the company's financial state at a given moment. It provides a snapshot in time that can be used to determine how much the company currently has, how much it owes, and what is left for the owners. The cash flow statement is based on numbers from your income statement and balance sheet, and is like looking at your own checking account. It shows you what the company did to generate cash and how it used cash during a given period of time, often monthly, quarterly, or annually, like the income statement. Thus it answers 2 questions. Where is my cash coming from, and where is my cash going? Remember, while each statement has a different purpose, all 3 are necessary in helping us understand a company's complete financial story. For example, if you want to know whether or not a company is profitable, the income statement is what you need. Even though you know the company is profitable, if you want to know how much money the company has available right now that you can spend, you want to look at the balance sheet. And regardless of profitability and current available cash, if you want to know where cash came from and where it went, you look at the cash flow statement. Each document fills in a piece of the puzzle to complete your understanding.
In our Blackboard this week, in week number 2 in lecture notes, there's a spreadsheet file. The spreadsheet file is called the week 2 in-class review spreadsheet, and it is a template and some examples of financial statement. Chapters 3 and 4 in your text are talking about what these statements do and how important they are to financial management. Remember, accountants put these statements together, but it's the financial manager or the business finance or the corporate CFO who takes this information from the financials and applies strategy and information to manage the company into the future. And as it says here, for this company, Reggie Dunlop Incorporated, this is the 2020 and 2021 financial statements, balance sheet, income statement, statement of cash flow, and then an analysis of the financial statements in some key financial analytical terms that you need to know from Chapter 4. Remember, financial statements provide a historical review of the company. Are we maximizing the return and the value of the company? This puzzle is painted, and picture is painted in the financial statements. As I mentioned earlier, it provides data for future planning and financial management. So let's just make sure we are familiar with the financial statements. The balance sheet is a statement on a given date, most notably December 31st, of the statement of their assets, what they own, their liabilities, what they owe, and their equity position of the company. Remember the three major sources of capital in a business is debt, owner investment, and profits. And that's what the balance sheet tells us. It's a statement of assets, both short-term assets, assets that have a life of less than 1 year, called current assets, and long-term assets, most notably fixed assets. Sometimes they're called property, plant, and equipment. Assets that have a longer life than 1 year. The combination gives you your total assets. The same thing holds true with liabilities or debt. Short-term liabilities are due within the next year, most notably accounts payable, any loans currently due in the next year, notes payable, and accruals. And then your long-term debt that's due over a year, most notably bonds. Then you have the equity section of a balance sheet. It's broken down usually into 2 main areas. The value on the books or par value of the common stock that you have issued to investors in your business, and then the retained earnings or the profits that you have held over the course of the company's lifetime in profits. Remember, retained earnings is part of the closing of the books. Retained earnings is the profits you keep after you've distributed dividend to your shareholders. And where do those profits come from? The income statement. An income statement is where the balance sheet is for a given date. The income statement is for a period of time, in this case, 12 months. It's sales, expenses, operating profits called earnings before interest and taxes, interest on the debt, earnings before interest and tax, or earnings before taxes, and then you pay your taxes, and then your profits. Or in this case, the company lost money in 2020. Also, some information is given on dividends. Also, some information given on this company's stock price and the number of shares outstanding at the end of those subsequent years. One thing to note, remember I talked to you earlier about retaining profits. When a company closes their accounting books, they close all the temporary income statement accounts, revenues and expenses. Those closings show that the net income is $253,584. If you notice in retained earnings up here, retained earnings is a net delta in 2021 of $198,000. Well, that sure doesn't look like $253,584 because remember, retained earnings is profits less dividends. And this company in 2021 paid 22 cents a share to each share of stock, and there were 250,000 shares of stock. That's $50,000. So you subtract 50,000 from 253,584, you get your 198,584, a net increase in the retained profits of the company. So the balance sheet and the income statement tell us about the operations of the company on a given date and for a period of time. The cash flow statement tells us about where the cash came from in the business over a period of time. Operations, financing, investing. And basically what the cash flow for operations is the delta of the balance sheet. Notice cash and equivalents had a change of $6,718. That should be the bottom line in your cash flow statement. $6,718 cash went up for this company in 2021. How did that $6,718? Well, it came by three areas: operations, financing, and investing. The net effect of all these three is $6,718. And these particular areas of the financial statements are shown here by the deltas, the change in the accounts. If assets go up, that means cash was dispersed. We purchased something. If assets go down, that means assets were sold. If liabilities go up, that means cash was received because we borrowed more money. If liabilities go down, cash was dispersed because we paid off a loan. If equity or stock goes up, that means we received additional cash for issuing more stock. If retained earnings goes up, it means it's the net of the income statement of profits and dividends. All these are in the cash flow statement, distinguished by how they affect the specific three segments of a company: operations, financing, and investing. Here's, I like to call the cash flow statement looking under the hood of a company, looking at the details of where the cash flow went and came in to the business over a period of 12 months. The balance sheet and the income statement tell us in the big picture what the financial position of the company is and whether they're making any money. But the cash flow statement tells us the specifics of where cash came in and went out. Notice here, under operations, we had negative $170,536. That means more cash went out than came in from operations. And what caused that? Accounts receivable and inventory greatly increased. Meaning if accounts receivable goes up, that means we haven't collected the money. No cash came in. If inventory goes up, that means we spent cash on inventory and have yet to sell it or turn it into positive cash by selling it. Cash came in with net income. Cash came in with depreciation. Depreciation is an expense. But the company, when they book depreciation, some of you might remember this from your accounting days, they don't write a check to Mr. or Mrs. Depreciation. It's an accounting entry. It's not the spending of cash. So depreciation is considered positive cash flow for a business. You're expensing something, but you're not actually spending the cash. Why are you expensing it? So you can get, it reduces your tax liability. And that's what government gives you by giving you the tax benefit of investing in an asset, allowing you to depreciate it. It gives you that benefit. The same thing holds true in the financing section. Notice notes payable and long-term bond accounts on the balance sheet both went down here and here. That means the company paid $920,000 out to reduce some of that debt. That's money going out. But at the same time, a huge delta in common stock. That means, remember, they started out the year with 100,000 shares. They're ending the year with 250,000 shares. They sold 140,000 shares of stock in 2021 and took in 1,220,000 of cash. And here it is right here. And also they wrote and paid 55,000 out in dividends. The net effect of this was they had a positive cash flow from financing. And finally, investing. Investing either in investments like short-term investments or additional assets called fixed assets, buying more equipment. They didn't do much of that in 2021, but they did spend cash on new assets, either investments or plant and equipment. So you had 170,000 going out, 246,000 coming in, 69,000 going out. The net effect, 6718. And there's the delta in cash. So the cash flow statement, especially for investors or potential investors, lets the public look under the hood of the company and see where they're generating cash flow or no cash flow. A very important statement to remember in business finance. And then finally, we get to chapter 4, where there's some key financial ratios that you need to be familiar with. Talked about in the chapter: current ratio, debt ratio, profit margin on sales, return on total assets, price earnings ratio, and earnings per share. Make sure you know all these 6 ratios. These financial formulas are mentioned on page 120 of your textbook, and in my lecture notes for week 2, I give you that page here. So in one easy session, you can see all the definitions of all the relationships or ratios or financial statement analysis talked about in chapter 4, but you're just concerned about 6 of them. And this is your study guide for that. So again, you need to concern yourself from chapter 4 with these 6. And here's a tab that shows how those 6 relate to the financial statements of Reggie Dunlop Incorporated. The current ratio is current assets divided by current liabilities. And for 2021, that was rather high, 2.58 to 1. The reason for that, accounts receivable and inventory are very high. This is called the liquidity ratio. Is the company liquid? The higher the number, the worse it gets. The debt ratio is the percentage of total debt to total assets. Well, remember, we just talked about in the cash flow statement that we paid off $920,000 of debt during 2021. Naturally, our debt position was reduced significantly during the course of the year. This is called debt management. The profit margin on sales is the relationship of net income to the sales of the company. It dramatically improved in 2021 because they finally made a profit. Remember, they lost money in 2020. The return on assets is the net income or profits divided by the total assets of the company. And naturally, that improved in 2021. The earnings per share is the relationship of net income to the amount of shares outstanding in the company. And as you see, they made a profit in 2021. So they had a profit of 253,584 divided by the number of shares of stock outstanding, 250,000, and you get your earnings per share. The price earnings PE ratio or price earnings ratio is the relationship of the earnings per share to the stock price. Oops, wrong one there, excuse me. Remember, our stock price at the end of 2021 was $12.17. What is the relationship of the earnings per share in a ratio. So we take $12.17 and divide it by our earnings per share, $1, and we get our PE ratio of 12.05 times. This is a big market or investment term. How greater, what's the relationship of the stock price to the earnings that stock is producing every year? The higher the PE ratio, not so good. You want to keep it pretty low, that relationship. So these are the 6 I need you to be familiar with for assignment number 1 next week. I'm going to be giving you some financials, and you'll be finding this information. Again, also, one of the key points of Chapter 4 is not only being able to find key trends or relationships in your financials, but comparing it to the industry, your competitors. And as you can see, this company is a little bit below some of the industry average of their business. That's another key point of financial statement analysis, is not only to see trends in the business, in your business, in your internal financials over the years, but how does that compare to your competition? Are you doing it right, or are you doing it wrong compared to the market or industry you're in? This is a key component of financial statement analysis. So chapter 3 is talking about the 3 main financial statements and what are they? Balance sheet, income statement, the cash flow statement. Chapter 4 is looking at key ratios and relationships from these financials that tell you about the liquidity, the debt position, the profitability, the market position or market value of your business. Very important to know these 6 for future studies in our course. So those are the key highlights of this week 2. So again, your key points this week are to understand that material that I just highlighted from chapters 3 and 4. There's our lecture review template that I just went over. I suggest you download that. That would be a good template and study guide for future work. And make sure you understand the financial ratios. This page taken out of the book right here, financial statement analysis, I would download, and then describing the key terms of the week. Because chapters 1, 2, 3, and 4 will be the topic of assignment number 1, our first assessed work, which will be distributed to you this coming weekend and due June 26th. So if you feel comfortable already with financial statements, you're in pretty good shape. But if it's been a while for you to get that financial information or to have to study accounting financial statements, this will be a quick review. The video in Blackboard and also on our YouTube site, and this review video here. Well, that's our week 2. Next week, we talk about the future and present value of money. Enjoy your week. I will have an update over the weekend, and have a great rest of the week. This is Professor Hasse. Adios.